Well, welcome everyone. I have the privilege of inviting back on the pod today our friend Pete Moore. Pete, how you been, friend?
Good to see you, Brian. Thanks for having me on. Happy New Year, and look forward to another banner Halo year ahead.
There's a lot to talk about, but before we jump into that, I see you got the University of Miami garb on.
Yeah, yeah, it's a $37 purchase from Amazon, which might be one of the best jewelry purchases of all time. So I'll be wearing this on Monday. My grandfather, as I mentioned to you before, was a huge Miami Hurricane fan. Passed away 30 years ago, but he used to sit in front of his black and white television in Hallandale, and he was always yelling at the Miami Hurricane. So in tribute to him, I wanted to wear my hat and my chain for this podcast. So he's watching from above. He'll appreciate it. He'll chuckle.
That's fantastic. I know he's smiling. I know he's smiling. Hopefully he's going to be smiling bigger after the game Monday, right?
Yeah, it'll be a good one. They've done a nice job with content production with the NFL and the NCAA football. So I've been a big fan, and I'm impressed with the talent level.
Yeah, it's going to be a great game. I'm looking forward to it. I'm looking very forward to it. Well, Pete, you're probably one of the top experts in the world on all things finance in the fitness and in the hollow space that you cover so closely. We've seen so many transactions. I mean, in the last year and a half, I mean, we just see eGym just announced their deal with Playlist. We've seen the acquisitions by Basic Fit. We've seen the investments in Crunch and EOS. We see Genesis buying up a lot of facilities. We see, Gold's Gym SoCal and EOS. I mean, lots of M&A activity, lots of PE activity. We talked about it being a combination of a lot of factors, consolidation, money. What is your commentary on the current state and what we're seeing happening right now?
Well, look, first, kind of hats off to the operators in the business that are proving that you can run a big box gym or a HVLP or a big sports complex, and you're generating the unit economics that are attractive to institutional investors. So all these private equity groups that are out there, and you mentioned 8,000, let's say it's like a couple of hundred that have real dedicated funds that are saying, where am I going to deploy capital? And in the retail and the consumer space, that's a very difficult game to play when you see all these bankruptcies of these traditional, shopping retail concepts, and some of the carnage on the fast casual or the casual restaurant side. The health club and the Halo sector, bricks and mortar, has really been resilient over the last 4 years post COVID. Obviously, a lot of people love to see the revenue growth, and some of that, you and I know, is just basically getting back to where we were pre-COVID. But it looks really nice in a bar chart, in a PowerPoint slide. And from a standpoint of the unit economics, I think the operators in our space now are really on the pulse of understanding what the consumers are willing to pay for, what they're willing to upgrade to, and actually becoming that third place that everyone used to use the term, your health club is your third place. I think it actually finally is physically where people are going, 2, 3, 4 times a week and even more, and then using a Lifetime Fitness or a Bay Clubs or a big box sports club complex as like their go-to for their family. And they've proven that, and the attrition rates have gone down pretty dramatically. But, from a standpoint of entry points of new private equity firms getting into the space, I think they look at that and they say, okay, if I could get into an EOS, which, people would say was anywhere between like a 10 to 13 times, EBITDA transaction with TSG, those guys have proven that, look, I could do $1 million of EBITDA plus minus, per location. And here's where I can grow to. And I don't have any constraints by a franchisor that can tell me what my territory boundaries are. So that made a lot of sense for TSG. And those guys have proven, Drenberg and team over there, that you can continue to build out and you can scale that business. So I think the private equity firms are looking at first at unit economics, then they're looking at scalability. And then they're looking at, okay, what can we do when we get to that next level of adding new, profit centers, not cost centers, but profit centers, into those boxes. But the private equity groups, they're looking at anywhere between on the low end called like 18% returns
Yeah.
on their capital deployed up to 30%. So to buy a health club chain as an acquisition for an EOS, when they bought Gold's Gym, SoCal, or you take a look at some of the Crunch area developers that are buying up Crunch franchisees, or Planet area developers buying other planets, or conversions. If I'm a seller and I could sell my business right now for 5 to 6 times club level EBITDA and take out all of my corporate overhead when I'm trying to get into the transaction. I know you've done some, and I'm trying to anchor people to that. This is what your valuation is at 5 times, which to an owner might really be like 6 or 7 times.
Yeah.
And to a buyer, it's like, hey, look, I can avoid the year to 2 years of construction and ramp up. I could buy a membership base. A lot of these companies are on the same software. So a lot of deals that we've done recently over the last 2 years, buyer and seller have both been on ABC, which is very easy. So you don't have a technology, black hole that might, you might lose data and revenue. And if you take a look at the cost to build a club right now, if you have a 20,000 square foot club, that used to be $80 to $100 a square foot. So it'd be like $1.5 million to $2 million. Now it could be, $150 to $250 a square foot. So when you kind of run the math on why is consolidation happening, I think that buy versus build equation has gotten very much in the green light of you should buy if you can buy it, right? And I think the average operator who's a buyer right now is less aesthetically concerned about buying someone and turning it into their brand. To give you an example, it was probably 10 years ago now, I walked a couple locations in Texas with Lifetime Fitness, and they were looking at the Spectrum clubs, if you remember those back in the day. And I remember walking through the clubs, and the head of real estate development at the time walked into this one club. He said, perfect, I love this. This could be a Lifetime. And then we walked to the next club, which was doing twice the amount of EBITDA as the first club. And he's like, I have no idea why they put the staircase on the right-hand side. The staircase needs to be on the left-hand side when you walk in the door, because I can't do this deal. Like, I can't put my Lifetime logo on it. Whereas, you take a Planet Fitness operator or you take a Crunch operator, they'll say, like, look, we'll figure out how to make this thing work. And they're concerned about, like, the details of the aesthetics and the structure. So, you've got the buy versus build, I would say, is kind of like exhibit A. The unit economics that these clubs are making money, and it's not a distressed, turnaround story, is kind of like exhibit or reason 2. And then I think the third reason is when you're in a brand like a Planet or a Crunch, I'll just be completely transparent here with the audience. It used to be if I sat on a 20 store or 20 club development agreement and I was friends with the CEO of Crunch or the CEO of Planet, and I said, hey, I haven't built that out yet. They're like, bro, don't worry about it. Like, get to it when you get to it. Those days are over. If you have territory and you have a development schedule and those groups are owned by large, institutional private equity funds that I would say are like major league private equity funds, there's no tolerance for empathy. We got a written agreement. You got a territory. You got to build it out, or I'm going to find someone to build it out, like the story. So, you've got this urge and mandated requirement to have additional locations because I gave you that territory. And you have to come through with your side of the bargain. And I really don't care, quite frankly, as a franchisor. I love you and I love collecting your royalty fees, but they have to come in. And I don't care that, you have a tight real estate market, or, you haven't been able to get a deal done with a counterparty that you say you're going to buy. Like that's kind of on you. So those are like the 3 things that are affecting this frenzy, if you will, right now in the middle market. And then I would say the fourth part, which you and I know because we've been around for a long time, a lot of the owners in this business that have multiple clubs are in their, late 50s up to like, mid 70s, and I've known them since I was, a kid in this industry. And when you and I first met, I probably had I didn't have any gray hair, and I was running around without a hat because I wanted to prove like how young I was and how much hair I had on my head, which I don't have as much of. right? So a lot of those guys are like, hey, my wife is not involved in the business. My kids have nothing to do with the business. They don't even show up at the club. They're not even members.
Yeah.
Like, so there's nobody for me to pass this down to.
Yeah. Yeah.
And my manager, says he wants to buy the club or she wants to buy the club, but they can't get SBA loan to pay me back, which is kind of forcing people to sell. And what I hope is that the buyers in the business make these acquisitions of the legacy operators, because you run a Buxton report or you run a real estate report and they say this market can put in another 20 clubs, and then that Buxton report gets shipped out to 5 different buyers, makes it seem like there's 100 clubs. Well, there's only 20, bro. So, and I'd rather buy the 10 clubs that are already existing, and you don't have this competition in the market. Everyone says, oh, you can have a club across the street from each other. Well, people eat like 5 times a day on average. They don't go to 2 health clubs a day on average. So I'm hoping that irrational development does not become, a break in the industry where people are going to a low price common denominator again. Because what you see, which is awesome with Planet, is that Planet's raising their prices, right? And in New York City, as an example, where I used to live, I moved. It would cost me more to take an Uber to go to one of my Crunch clients than they charge it for a month in membership dues. So I think the price, people are starting to finally say like, hey, I'm going to be a $99 price point club, and if $3 a day is not a good use of your money as a consumer for what I'm providing you, I'm not going to get you in at $9.99. A lot of these teaser pricing is like teaser pricing. It's not necessarily the real pricing.
No, that's right. And so given that kind of backdrop, and I agree with you, I mean, you have a lot of these variables that you so definitely identify. And one point before we start talking about what you see coming next, I forgot to mention Mark Mastrov's acquisition of 24 when we were talking about, I mean, there's so many of them, I can't keep track. But anyway, so given all these dynamics, and I know recently you spoke about this on some of your content that you posted, what do you see happening in the future? I mean, we're looking at what, a 2, 3, 4-year window as far as this continuing, or where do you see this going, Pete?
Yeah, I mean, probably about 6 months ago, I was wearing a doctor's scrub shirt, and I was pretending I was like Dr. Halo, and I said, if you're an independent operator, you got 36 months left in order to either get a deal worked out with somebody who's coming into your market because they have contractual rights and obligations to do that. Or find a deal or to get outflanked by them, unfortunately, because when somebody, as you know, is using private capital, they don't go to the bank and sign a personal guarantee on debt. They call capital from instant, endowment funds and pension funds. They don't sit down with their wife, with a significant other, or their husband and say, you okay, leveraging all of our assets in the house and filling out this personal financial statement. It's completely different game, but it's being played on the same board. You and I can play chess on the same board, or we can play checkers, right? But the worst part is if I'm playing chess and you're playing checkers, or vice versa. And that's basically what's happening right now in these markets. I was on the phone yesterday with someone, and there was money that came into Amped, AMPD, with Princeton Equity Group, who owns D1 Sports Trading and Barry's Boot Camp, to back Amped, which is kind of I'd say like a mini EOS would probably be a good way to explain it. And the operator I was talking to was like, where are these guys getting this money? Like, how are they building so quickly? And it's like, because they don't sign personal guarantees, and they don't go to the bank and like ask for money. And the bank says, we'll come back in 6 or 12 months when you have more trailing cash flow that I could lend to you. They're going to groups that say, I want to fund your build out. And if you find a location that fits into these parameters, like I'll give you the money to do it. It's completely different, set of, investment criteria and decisions that are being made. So I said that 6 months ago. I think there's 30 months left of this M&A, land grab and market share consolidation. And then I think what's going to happen, because like I've seen this movie before, so I know what happens. So we're like in the halfway through the movie. And what happens towards the end of the movie in 30 months is all these private equity firms talk to their operators and they say, okay, time out. We're not spending any more money. We're not doing any more acquisitions. One is I might have to sell the company within the next 12 months to get a return. So I don't want to buy something and then maybe not get credit for how we improved it. One. Or two, guys, like we acquired like 50 clubs, like 20 of these things are underperforming. I don't know what the fuck's going. Like I need, like, let's just focus on what we have, not focus on the next deal. And so that is inevitably going to happen, right?
Yep.
Nobody goes that's a 1,000 when they do M&A.
Right.
So I think you got 30 months left of this, phones ringing and people in buy mode, and then there's going to be like a 2-year pause on that, and there might be some macroeconomic factors to that as well.
Yeah. The markets are at all-time highs. Valuations are very, very high right now in general. And I think you've mentioned this has been sort of a super cycle as well. A lot of things converging. But yeah, I agree with you. I think we need to be prepared in another few years as to what that next phase will be.
Yeah, and look, I mean, if you're a seller or if you own a business right now, and let's say like 2 years ago in 2024, you got back to where you were pre-COVID, and you're still kind of like ticking up maybe like 2 or 3% on your revenue, and you've seen this countless times as I have. Once that revenue starts going down, once those members drop, then a buyer just thinks that they're catching a falling knife, and they discount that down to the point where they think where that trajectory is going.
That's right.
So and then if you're in an area and you find out that Crunch just signed a 20 store development deal and you got a pretty tight market, there's no way that your revenue is not going to go down, right? So you just have to think about, back to the PowerPoint slides and the bar charts. If I'm down 10%, year over year in revenue on every one of my clubs, there might be nobody that buys your business,
right?
Where if you're neutral or up 10%, someone's going to say, okay, I'll buy this because I think there's more upside and I'm buying a healthy business. So there's also those types of things. And also, just so people understand how this game works, there's people inside the company, or there might be a private equity junior professional that is doing the work to buy a business. And then they inevitably have to go and get investment committee approval. And that's usually a Word document and some PowerPoint slides. And those graphs and those charts matter to getting approval. So you want to always sell a business when it's looking rosy and things are still, and somebody still has a bite at the next apple, not when somebody thinks that, hey, this thing's tapped out, now it's going in the other direction. How far down is it going to be when I buy it, and what's going on? That's what happens.
Yeah, makes all the sense in the world. Let's talk for a minute about tech and what's going on there. I mean, there's been a lot of talk about tech. First, a lot of businesses in the space from a supplier side, a lot of money has been put into technology. When you think about operating models in general, though, in my observation, I haven't seen a lot of brands do a lot of things that are really innovative around tech. What do you think that is? Do you agree with that or not? And then what do you have any thoughts or insights as to what that is?
Look, I've been waiting for, the real like data scientists to like reveal themselves, behind the curtain. Because for years, people, the technology company tells me they own the data. The club tells me they own the data. Some intermediary or middleware company tells me they're manipulating the data, and then there's been episodically people that come to me and say, hey, I look at people's data and I tell them what the probability is of these people canceling, right? As if it's like a whiz bang thing. And I'm like, well, you can pay me $500. I'll just go through and tell you everyone hasn't checked in the last 60 days. Here's your fucking list. I mean, I'm not really sure if that's like AI or if that's just like intuition. But I'm hopeful and optimistic that all this data that's sitting there, and we work with a company you might know, Promotion Vault, where they're like getting questions answered, and there's all this information, but I don't know if anybody's really using it the way they should to optimize this. If you look at you go into like an ABC database or a Zenoti database or what have you, Like I'm waiting for someone to tell me, hey, these are like the 2,000 out of 10,000 people that are training for high rocks, let's say, because that's a big thing
Mhm.
now, right? I know that in order for them to train for that, they should have a certain apparel, they should have a certain sneaker, right? And I'm going to now go do a deal where through my health club, I get a $20 or $50 gift card for that specific sneaker, and that company is advertising inside the club. That just hasn't happened yet, and I'm
Yeah.
shocked. I'm shocked that it hasn't happened yet. Um,
Yeah.
so I feel like there's big technology stacks. Al Nashavani, a good friend of mine,
Mhm.
he's been talking about that. Like you have like these tech stacks keep getting bigger, and then people think that they're shrinking them, but then they seem to expand on their
Yeah.
own again. So I don't know the answer. I just know that there's a lot of talk about data and technology, and I just hope that people spend the time using it properly. It's a weapon, right? I feel like
Yeah.
it's like an untapped weapon that
Yeah.
people are almost like scared to optimize.
Yeah, well, I think you even had, I think it was, I forget who your guest was offhand, but he was talking about Planet Fitness's earnings report, and they were saying how they were starting to de-emphasize evergreen kind of growth and more about optimizing retention, all these other things, which is more of an operational focus that would be in line with your description of what you should see to start happen in the next 30 months, where and that's when you need these tools that are technology driven to kind of help you optimize what you have. And maybe those things kind of come together, whereas people start focusing more on optimizing what they have instead of just acquiring new assets. Maybe these tools will become more and more relevant to operators.
Yeah, I think technology when used appropriately can really you can generate a lot of return on
Yeah,
that technology investment. And the one good thing I will say about private equity is they're not trying to find the lowest cost
right,
technology provider. They're not trying to jam somebody on a SaaS fee. Like they'll pay it if it's valuable to them. But what I would say is that as much as AI will optimize your business. And I haven't figured this out myself. If you give me something that's written from I still read at the same pace
speed.
and
Yeah,
speed that I did before, right? So what you
right.
do is you deliver me information, but I just still have to
Yeah,
digest it. I have to
yeah,
understand and now I have to deploy it. So as much as people say like, oh, AI is going to change my business, all right, yeah, that's great. I just saw like there's a McDonald's that doesn't have any cooking. Did you see this thing in Fort
yeah,
Worth?
yeah, yeah,
100% drive through. I mean, that's great. But if I'm an operator of 50 locations and I've got 500,000 members, and you actually want to like learn what these members are doing, not
right,
necessarily on an aggregate basis, but why not just on a personal basis, and say like, let's go through each one of these people and see what their goals are, see how much weight they lost, see how many people they referred to us, how long have they been a member, how many days they check in. I feel like if you did that and not say, well, that person's only paying $20 a month, let's say. It's like, well, they're not paying $20 a month. They're paying $240 a year, right? Plus they're paying, let's say, a $59 annual maintenance fee. Like, would you spend 5 minutes to get $300? It's only 5 minutes, but you have to have
yeah,
somebody like manually use their brain and digest it. So that's why I
yeah.
feel like the data and the technology and the AI and the scalability is like, let's get all the data, but then like I have to have somebody that actually wants to read it and like
Right.
interpret. So
And use it. Yeah, use it
yeah,
as a
use it.
tool.
Yeah,
Yeah, good observation. Well, Pete, thanks for making time.
yeah, of course.
I always ask a great final question. I hope you think it's great. You shared some of them, but what pearls of wisdom do you have for folks today as they're looking at their businesses in the hollow space? What are some things that you're seeing, et cetera? What should people be focusing on and thinking about right now?
Yeah, and you kind of touched on it before, but it's really two things. One is master the business that you currently own. All right. And a lot of people get distracted by
Yeah,
trying to bring in new things into their business that
yeah,
might quote unquote like optimize or like fix their core business. You have to master your core business and you have to live in a location that you have as your prototype. So if you're going to go to an investor and you're going to say, this is how my business model works, you have to live that business model. You have to fully understand all the different components of it. And don't try and go and build a second location or a third location until you master and optimize the first one. The second thing I would say is, through this phrase that my old boss, Peter Brockway, who's a good friend, used to say, is experience is what you get when you don't get what you want. So you have a lot of experience running your business. Don't lose those learnings by trying to like outgrow and say that was a mistake I made. It wasn't a mistake. It was something you learned. Now you can like figure out like what your business model is. And also as you continue forward, figure out where you want to be and where you want to get to. If someone came to me the other day and said, hey, I want to build 50 clubs, right? And they have 10 right now. And I'm like, okay, how old are your kids? Like, do you want to be home at all? Do you want a private equity partner that you report to, right? Because you are now you're an employee of a investment firm. You're not an entrepreneur anymore. How far are you willing to drive from your house? What are you willing to sacrifice? And then kind of back into like, this is where I think I want to be financially, if that's your goal.
Right.
That's like you want to say like my life's work is these 50 locations, which is awesome. But figure out like how you really get there and what you're willing to give up to get there. Because there's no shame in having 5 Pilates locations in Lafayette, Louisiana, and owning that town and helping 5,000 people feel and look awesome and have a community. Like you don't have to go and say, let me go get private equity. I want to go to Baton Rouge and I want to go to, Nashville. It's like, do you really like what for what? Like, what do you get for that?
Yeah.
So
yeah.
I feel like people want to, like, you should grow when you're ready to grow. You should master your current prototype, because once you master the prototype, then you can really scale,
Right.
So that would be a couple of takeaways, from where my brain's at today. And say no to a lot of things that don't make sense.
That's so true. And it's the FOMO thing versus basic fundamental strategy and decision making. I think a great advice to begin with the end in mind, as Covey said, the famous Covey. Great. Listen, happy 2026 to you and yours.
Likewise.
Appreciate you spending time. Know you're busy. And I look forward to catching up again soon.
Yeah, I'll see you in person at the next show.
Yes, sir. Take care.
Go Halo.